Marvell Technology. Now, Marvell is a semiconductor solution provider of high performance data infrastructure, makes semis that go into data centers as well as the network infrastructure related to said data centers, i.e., it makes memory and storage sense. Right. Net margin very inconsistent. Um, Look at that. Went from 0 to 30% to negative 11%. Very inconsistent net income margin, below industry average, which is about 18. Worrying. So the margins are worrying for me, considering that it does operate in the high margin data center market. Companies tend to have higher margins in this industry, and it is very, 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 very competitive. So you could understand why the margins are so low. It could be, you know, Marvell could be probably cutting prices, right, to be able to compete with some of the big boys. Yeah, but worried, just a bit worried. So it's not a consistently profitable company. So it's important in this stage to determine the path towards profitability. Now, you will see costs have been either increasing at a decreasing rate or are basically flat out being reduced in the form of R&D growth. Even though cost of revenue is up when compared to 2020 and 2021, still at a declining rate considering what it was at 2019. So you understand why this is. You're trying to protect margins from the effect of COVID as well as to remain competitive. So, reducing your cost to be able to give your customers a much more efficient, better price than the competitor, than your competitors, than your peers. So cost reduction basically a response into protecting margins. Now R&D, pushing towards R&D is quite high at 36%. The industry average is about what 20%, and it's at 36%. So the R&D is operating at above industry average. You kind of expect that considering, this is a highly competitive market and you're trying to wrestle some profit away from some of the established players in this market. So you can understand the above industry investment in R&D. That's okay. Revenue growth is a bit inconsistent. Bit inconsistent. However, it's in line with the industry average. On average, over the past 3-year period, Marvell has been growing revenues at an average of 8%. Industry average was about 8%. So very good. Very, 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 very good. Well, not very, very good. I guess it's decent. It's in line with industry average. But again, considering the fact that the margins are basically abysmal, you have reduced cost a bit, but that cost investment has at least realized some growth in revenue. Now, just a bit quick, now the poor performance of Marvell can to a degree be blamed on COVID. Um, but certain competitors do have a bit of a rosier picture. So just keep that in mind. I know we're not done with the analysis yet, but you know you need to keep in mind the fact that there has been an increase in what is spending in digitization. Everything is now on the cloud, and this is the market that Marvell thrives in. Providing these semis that are needed to power data centers, to power this, yeah, what is it, digitization drive. So you would expect I mean, not mind blowing results, but you would expect a bit of a rosier picture. Hmm. But anyway, like I said, COVID can be blamed to a degree, but I would have expected a bit of a better performance. All right, so growth in net income, dismal. I mean, it's at a negative 140. Uh, you know, COVID has affected many companies differently. There's some companies that even though COVID hit, decreased costs, but still managed to protect margins and grow revenue as well as grow net income while remaining competitive. Marvell, it has remained competitive. It has reduced costs. It is growing revenue. The margins are just tanking. They're just tanking. So COVID really was not kind to this company. Okay, so now, as you say, the net income is negative, but highlights the struggles that Marvell has been experiencing basically to grow revenues at a sufficient enough pace to realize productivity from costs invested to basically grow revenue. So, yeah, you know, not, not really impressive. I mean, it is a good company, but I'm just not impressed. Now, the ROE just follows the terrible financial performance. The ROE has deteriorated significantly from 2021, sitting at 2%, which is a laughable rate. But it, it does highlight again the inefficiencies of Marvell to make returns on invested equity. It does highlight its troubles. Yeah. Okay. So the financial performance, well, has been abysmal. It highlights Marvell's basically struggles to compete while growing revenues at a sufficient enough pace. Um, but what one can be buoyant about is the fact that costs are pretty much under control. It's not spending for the sake of spending. It is spending with the view of future profitability. Looking at the fact that getting costs under control, but still maintaining a fairly decent investment in, even though it's decreasing it, it's still at a fairly stable rate above industry average and still growing revenue, be it small, but it is growing. So it has struggled a bit, Marvell, but it is spending, but not just spending for the sake of spending. It is spending for the sake of profitability. Yes, it's been bad, but you know, when you look at the intention, I think when you look at the future, you will see this as a company pivoted towards long-term profitability. So currently bad. It's really, really bad. But what one can be buoyant about is the fact that it does have a bit of a long-term view on future profitability. All right. Now the financial performance. Current ratio. Wow. All right. Now, first, before we get into all of that, it is very important, especially for me, with investing, to make, to determine that even though, a company might not be profitable, to determine the path towards profitability. But in addition to the path towards profitability, I need to see a strong balance sheet. Now, the current ratio, starting off with that. Now, the current ratio, the average performance over the past 3-year period, 2019, 2020, 2021, was sitting at 1.95, so just under 2, below industry average of about 2.37. Uh, however, I'm not going to throw a hissy fit. You know, I'm not going to hesitate about it because it's still above one arm and there has been a deterioration, but that deterioration has been a deterioration. I'm not happy with that deterioration. However, it's still above one. And the deterioration is mainly caused the the drainage of cash being invested. So a lot of cash has been invested into the business. That's what resulted in basically deterioration because the cash on hand has decreased. But at above one, I'm still happy because it shows me that Marvell does have relatively sufficient enough short-term assets to cover short-term liabilities as and when they fall due. Okay, very good. Very, very, very good. All right, now going on now, the situation, like I said, it worries me a bit, but it does have plenty of what is it, current assets or short-term assets to cover short-term or current liabilities as and when they fall due. Now, the asset test ratio, looking at its average performance over the past 2 years, it's below the industry average. Industry average is about 1.88, but again, bit of a risk but not a heightened risk. So it does worry me, but does not turn me off the stock completely. To a point I'm saying, okay, you are in a terrible liquid position. You still have enough liquid assets. So these are assets that can be quickly converted to cash. You still have enough of those to settle your short-term or current liability. So worried, but not too worried. Now the inventory days again supports the fact that Marvell is in a decent liquid position. The inventory days, the industry average over a 3-year period is about 101. It was above 101, just over 101 days. Marvell's average was sitting at 86, just over 86 days. So it's far below the industry average. So this is very, very pleasing because it indicates that Marvell does have low liquidity risk in relation to inventory because it does not hold inventory on its balance sheet for longer than the industry. Right? Now, this is a good sign of good asset management because stock not hold longer for what is needed. Not a lot of stock is held in my not a lot of stuff is held on my balance sheet, basically improving my liquidity, as you can see with the asset test ratio, meaning I have enough liquid assets to settle liabilities. So from a liquidity point of view, these two ratios underperform industry average, but this has overperformed industry average. And when I read this, yes, it's underperformance, but is that underperformance worrying? No, not really. Not that worrying. Still has sufficient short-term assets on hand. Doesn't hold inventory for that long. Good asset management. There is a bit of a liquidity risk caused by that current asset ratio, but it's not that much. Now, the fact that the inventory days are below industry average just gets that liquidity risk down. So the liquidity risk is not that high for me. The no, okay, so good. All right, so the debt to equity ratio. Very impressive considering the industry average of 126%. Very, very, very good. Now this means that the financial position of Marvell, so the balance sheet, is not that financially risky. It doesn't have a lot of financial risk considering you don't hold that much debt on the balance sheet. So all of these read together. Underperformance, not too, yes, there's a risk, but that risk is brought down by my inventory days and the fact that I don't have that much debt on the balance sheet. It does make this balance sheet just that much attractive to me. Not a really, 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 really risky balance sheet. The fact that you've got low debt just um, places less pressure on the balance sheet. Right now, the cash position. All right, the cash from operations margin has been increasing slight dip in 2020, but a massive pop in 2021. So it has been increasing below the industry average, which is about 32%. But I love the fact that it's been increasing. You know, it does now. This ratio does indicate that on that Marvell in 2021 can convert 28% of its revenue into cash. So it does highlight Marvell's cash generating effectiveness. The fact that the business model does generate cash from its operations is a very, very, very good sign. It's a cash generating entity. The sufficiency of cash flow has dramatically, I mean, dramatically improved. And you can understand this dramatic improvement because supported by two factors. Number one, the strong increase in the margin, so the ability to generate cash has been improving, has been increasing. The fact that you don't hold that much debt, so you don't really have a lot of money to pay to debt holders because you don't hold that much debt at the end of the day. So increasing, improving strong cash margins, low debt has really resulted in this fantastic number that we see in 2021. The sufficiency of cash flow from my point of view, it's really impressive. It's really satisfying. It's pleasing. It's below the industry average, on average. The industry average is about 0.84 and we're sitting at 0.51. Yeah, below, yes, there's an underperformance, but I am not going to really throw a temper tantrum considering the improvement in it, the strong cash generating ability, low debt. This is fantastic. And of course, it's above one in 2021, which is saying something considering most companies in the same industry tend to have sufficient cash flow way below one. So very, very good. Very, very good performance. All right. So the very, very good performance. I'm happy with it. Now the total return to shareholders. Now this is dividends plus buybacks. Marvell pays dividends and buybacks. You know, very high. It's very, 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 very high. Which to a degree, I guess could explain its the fact that we will see share price now. Share price is really, really, really done well. And you will see that it will explain the share price because it does pay a lot in terms of cash and dividends. All right. So it operates at a price to sales ratio. Now that makes comparison very difficult considering its peers are operating at a price to earning ratio. So this is a price to sales because it's not making any income, but its competitors are trading at a price at the price to earnings. So it makes comparisons very, very, very difficult. So, but furthermore, the cash position does highlight an entity that is well in a strong cash flow position. It doesn't just burn cash. It does have an operation that does make cash. Operations can make cash. There is a form of sustainability. It's not just burning cash. It does, at the end of the day, still have enough cash for them to run all operations needed. So a good cash flow performance. I just don't like that. The fact that it's operating at a private sales, it makes it very, very, very expensive considering competitors are operating at a price to earnings. So the share price, as normal, there has been a bit of a repricing in the market. So most high growth stocks are down, but overall, I think investing in Marvell has to go on your belief as well as your judgment of the metrics. It is a good company, but the fact that it's really not sustainably profitable compared to peers who are, it is to me a bit worrying. The fact that it's operating at a price to sales and competitors operating at a price to earnings, it makes it a meh company. One that I wouldn't invest in immediately, but keep an eye out.